have this as podcast on all of your favorite platforms. Please do me a favor and share the love. Let people know about these conversations on Spotify, Apple, Amazon, all that good stuff, and rate and review it. It takes quite a bit of effort for me to not only do these on my own, given my day job, but also to edit and get them cleaned up. So any help is always appreciated. With that said, my name is Michael Guyot, publisher of the Lead Lag Report. Joining me for the air is Karim. Patrick, I had your colleague Kevin on not too long ago. I'm a big fan of his way of looking at markets and yours. Introduce yourself here to the audience. Who are you? How'd you get interested and involved in markets, and what are you doing currently?
All right. Thanks, Michael, for having me on there. And so look, I'm probably had the journey that most new investors had. So let's say back in 2005 or 6, started making more money in my regular job, which was I was an IT guy there, Linux, AIX, like a real tech geek back in those days. And then I said, what am I going to do with all this money I'm getting into, accumulating funds? And the first trap I fell into is like most people, well, you fall on penny stock forums and you don't know. And then you hear, oh, this new thing, Trump vodka. And then you put all your money. You have no notions of risk and money management. You have no idea what a chart is. You're just listening to the news. And essentially, I was the cannon fodder, right? I was the crowd getting in late. That was me. And I always try to remember that, because as I evolved over time, so in like, let's say in 2007, after practically getting wiped out or almost getting wiped out a few times in these penny stock forums, the only thing saving me was like during the night, my heart would race and I'd say, oh man, something's wrong. Maybe I shouldn't have all my money in that stock. It was insane. And I'd sell the next morning. But then I discovered Stan Weinstein's Secrets for Profiting in Bull and Bear Markets. So that brought me to TA. In his first chapters, he says, look, he saw in the charts that, let's say, the casinos were breaking out in the early 80s while the fundamentals were horrible. He said, throw that all away, throw out all you hear, all the news, just look at the charts. When there's a new trend that pops up, that's what you want to ride. You want to be ahead of the curve. When you hear about it, it's too late. When people hear about Bitcoin, it's because it's already went up 10,000%. If it didn't go up 10,000%, then you wouldn't be hearing about it. But that was the opportunity, and charts will show you that. And that's since then, since 2006, 7, 8, I haven't looked back. I just kept going down the rabbit hole of charts. And yeah, that's where I am today there, Michael. So yeah, didn't want to go too long with that story, but I do understand what a new investor, the pitfalls, because everything's built around that, right? You go on CNBC, they don't really show you charts. They talk about what's popular, what's moved up. When you go on Yahoo Finance, the charts, they show you 6 months of data on a chart in their little screen. What do you want to do with that? You have to take a step back, right, to see the big picture. And hopefully I could help people see the turns and the tidal waves of capitals shifting from US growth stocks to hard assets, gold, silver, energy, oil, any stuff that falls on your foot and makes noise. We're living a paradigm shift towards those type of assets. And you could only see that if you zoom out 10 years, 20, 40 years, 100 years. You have to zoom out that much to be able to see these cycles repeating, or else the recipe that people had since 2011 when SPX broke out versus inflation or the producer price index, now it's broken down. So whatever game plan you had of buying the dip in these growth stocks, buying the dips in cryptos, that game plan will backfire now more often than not. So that people really, really need to be aware of that's happening. And nobody's talking about this, showing the correlations, showing the evidence in the charts, and that these stocks there, if you're on the wrong side, if you're choosing growth stocks in this environment, you'll get hurt. You might get a bear market rally, you'll feel good, but your profit target's probably not going to be reached. The rallies will be more often subdued than pushed up. And that's a big part of chart trading and what I'm trying to focus on right now, Michael.
Yeah, and I like that approach, because I think a lot of people look at charts just for very short-term kind of quick hits on profit, opposed to kind of looking at charts from a longer form perspective to try to identify when broader cycles are changing. I've used that line many times before. There are no gurus, only cycles. As you know, Patrick, is that it's hard to really know if a cycle has definitively changed until maybe 2 to 3 years after it's already changed. And it's kind of like the joke about momentum. You need to have some momentum for it to be obvious that there's momentum, or have already started, right? So how do you think about identifying major cycle turns? And whether what may be happening in the here and now is a legitimate turn versus maybe noise. And I say that because from my vantage point, I think last year was unequivocally an anomaly, certainly in the way that Treasuries failed as the flight to safety trade. I don't think that's a new cycle. I think that's maybe a reset of what's coming.
Well, there's a whole bunch of signals depending on what time frame you are. So the first major signal we got, if you go on the monthly chart, so the monthly chart, guys, it's kind of the sweet spot for me because I know you could go on quarterly charts, annual charts, and that means like that's the length of the candle. Then there's daily, weekly. Monthly is kind of a good compromise, which is giving you, if you're able to wait a month or 30 days before making an investment decision, if you're waiting for a monthly defined breakout or monthly defined trend lines, I don't think it's that hard of a sacrifice just to wait until the end of the month to get that signal, to reduce the false signals you get on daily defined breakouts, right? Those are a lot of whipsaws on daily, on weekly. So the month is pretty much a sweet spot. And if you're able to combine a monthly defined signal or breakout, confirmed breakout below a trend line or above, with a quarterly, even better, right? But you could start with the monthly. So the first big piece of evidence we had that we had a paradigm shift in capital flows leaving US growth stocks towards inflation sensitive or instruments that track destruction of purchasing power was back in, to be super precise, it was in April. So on the close of April in 2022, we had a super valid trend line from, let's say, 2009 bottom, and then it bounced once, twice, three times, four times. In March of 2020, that was a bounce on that rising trend line. And once the trend lines, guys, you need at least 3 bounces on them for them to be effective, to morph into existence. Until 3 bounces off a trend line, it's just like a possible trend line. It's just 2 dots. And the more bounces you have before it breaks, then the more valid it is. And the trend line that broke in April of 2022, 1, 2, 3, 4, I had 5 bounces before. So this on the close on the 6th, below that rising trend line, below the 1-year moving average, below the 3-year moving average, that was huge loss of momentum because a rising trend line, got to remember, sometimes it could backtest. The price could actually go back upwards, but depending on the angle of your trend line, the steeper it is, there's still momentum that could carry the price upwards. And people say, oh, well, I had a trend line break, but the price still went up. Yeah, well, the angle of your trend line could indicate that there's still fuel in a rally going up. But this trend line angle is the same one that we had from, let's say, 1980 all the way to 2003 or 2002 when the SPX broke down versus PPI back then, or it's the same type of angle trend line that we had from 1947 all the way to 1966, 1968 when US equities started faltering versus inflation back then. So that was the first big piece of evidence that something, big paradigm shift was happening. So now what's morphing to existence, now you're what I call those rising trend lines, I call them sleep mode line. You just shouldn't be in US growth stocks at that stage. After April 22, you just shouldn't be there because now you have a different breakdown momentum. It doesn't mean that the US equities can't make a rally and regain that momentum and go back up, but you just don't have the momentum. Just like you said, Michael, you need momentum to create momentum. Well, I just took away momentum from you. So why are you stuck? You're not able to go to cash. Why aren't you able to step out of the markets, let the markets, and there's opportunity cost, right? You don't know how long the markets will, something happen macro-wise, and that was a false breakdown. Will take 1 year, 2 years, 5 years. Why would you stay in US growth stocks, Tesla, name all of them, the FANG stocks, the crypto, Bitcoin, all that stuff? Why would you stay in there when you have a clear loss of momentum breakdown? It makes no sense for me. The only reason sometimes I try to rationalize why somebody would still hold is because somebody did not look at the charts. Somebody did not buy in 2011 or 10 when the signal was given to the inverse when SPX was actually breaking out versus PPI. Because the later you get into a cycle, emotionally, it's hard to get out because you see the guy who bought in 2011 Bitcoin or Tesla or name any tech stock that made a whole bunch of profits. You're getting into the market. You saw that guy do those profits. You're getting in close towards the end because that's just the nature of the beast. Unless you use charts, you're practically always going to be close to the last 10, 20% in practically any important move. And then you're there and say, Jesus, man, that guy made 100%. I thought I was going to get life-changing revenues, right? I put in my 10K, 20K, all the money I had. I thought I was going to get $1 million, like these guys pumping and telling me that's how much money they made. And then it gets emotionally, you're trapped. It gets very hard. Then it goes up, you make 20% on your 10K, you're super happy. But when it goes down, say, okay, it's going to go back up like it did previously in the cycle, but now the capital flows are leaving. And now you're below your entry price. And now you're deepening below. It's a trap. It's a trap. You get stuck. And then you keep, every day you're at the news, every day you're on Twitter following these fundamental guys or following CNBC, and they're telling you, buy the dip, buy the dip. And Jesus, it breaks my heart because nobody's looking at these from a risk to reward or probability perspective. Nobody is putting out any objective. I can't say nobody, but you can't. It's hard to land on objective evidence if you're not following a chart guy who's showing you clear cycles are repeating, clear breakdown lines, clear momentum slowing down. And you never want to be somewhere where the momentum's slowing down. You want to be where momentum has slowed down and is actually starting to break out and pick up steam. That's where you want to be. That's when you buy the dips, and then after that, we all look like geniuses, right? The guy, that's why there's 100 crypto accounts, thousands of crypto accounts there with millions of followers. It's because they had the capital flows always rising the lower tide, right? It's like, man, I put out a chart, people saying, oh, Bitcoin's different than crypto. Well, I compare Bitcoin, the Bitcoin chart, to the total market cap of cryptos, excluding Bitcoin. So the price of Bitcoin, I didn't want it to influence the total market cap of the cryptos. It's the same chart, Michael. I even overlaid Shopify. It's the same chart. Now you could overlay Tesla, Meta. It's all the same charts. They've been rising. Of course, cryptos weren't there before 2011 or Bitcoin, but they're all tracking the same capital flows. And now all the momentum, they're all breaking down. So essentially, guys, you could remove the ticker in the top left. I could show you a chart. And if it's breaking down, I'll just tell you to step aside. So it doesn't matter what the fundamentals are. It doesn't matter who the owner, who the management is of the company. It doesn't matter. If momentum is breaking down, no matter how good that company is, they're going to have headwinds instead of tailwinds. Just like nobody's mentioning this, but all the crappy companies, the crappy stock companies, and this happened in the run up to the 2000.com bubble for those that are old enough, all the bad companies, they still went up in price. I could have put a chart of a good company and a bad company in the bull era. The charts look the same, Michael, the same. So that for me, it's like I could do a mathematical equation and just remove that common denominator. Okay, well, it's not the fundamentals driving the price. It's the capital flows going to that sector, influencing those industries in that sector, influencing the stocks in those industries. And when the money's sloshing in, well, it finds a home and they all move in the same direction. So charts, they provide they can provide unbiased evidence to really keep your emotions in check and really tell you the truth. Momentum slowing down, I'm going to step aside. And if ever SPX breaks out versus PPI to the upside, and this was a false breakdown, then fine. Let's go back in, guys. Something's happening. Capital flows are going back into growth stocks. The market's discounting something in the future. And this is something often I tell people who do fundamentals. You're there, you're spending, I don't know how many hours a day calculating a whole bunch of stuff, metrics, tables, P&Es, and company owners, and management. Then there's another analyst doing that, and then there's another one, and then there's thousands of analysts around the world, and each of these analysts are pushing varying amounts of money. Some are pushing $1 million, some are pushing $10 million, some pushing billions for hedge funds, for pension funds. Jesus, who am I in my analysis to really grasp the aggregate of all these people buying and selling at different moments? I know some are going to buy at the monthly close, right? These big funds, sometimes they could only readjust, rebalance their portfolios on quarterly closes. Who am I as a trader falling into this and trying to go the fundamental way and being arrogant enough to say, I've got it covered. I understand why the company's moving the price and all that based on all these metrics. There's so many moving parts. It's insane. But what you could do, you could take a step.
And by the way, there's so many also different reasons for people, even though they see the chart maybe trending lower, to not sell, right? So one thing which I think is often missed in a lot of these kind of conversations around charts and how long these cycles last is that if you have some of these investors that bought into Tesla, they don't want to necessarily take the cap gain tax, right, by selling. So it prolongs these types of declines because a lot of the early investors are also worried about having a tax liability. And that, I'd argue, is what makes this sort of interesting, in that the argument would be that markets are efficient, that, trends tend to not last that long, especially when there's so much central bank actions. I'd argue that trends nowadays probably last even longer on the downside, to your point around this growth cycle, because the only place to be for the last decade was large cap growth. And there's a lot of embedded, unrealized gains that will not come out that easily unless you have even more pain than I think you've seen.
Exactly. It's look, it's fun because sometimes I like listening to guys who have this perspective, like you, Michael, who are able to maybe understand or put the words behind what I see in the charts. Sometimes you'll see me talk about narratives and stories, but for me, it's like the capital flows, like the ratios between these huge asset classes, they carve out the price charts. And then after that, the narratives are derived from the price action. So if your narrative is derived from actual price action that's derived from the capital flows, I think that narrative has a better chance of sticking, sounding like valid, than somebody having a narrative and trying to explain why the price is not or is moving in the direction of your review. Look, like let's say I look at the SPX to gold ratio. Let's say I have gold divided by SPX, so gold's relative performance versus SPX, and I would just put that ratio chart for over, say, 50 years, 60 years. I would pop it on the chart. I could overlay the silver chart. I could overlay the oil chart. I could overlay the miners, anything that's in that asset class, and it would track not the performance of the metal. It tracks the performance of the ratio, the performance of that metal relative to how many capital flows it's able to steal or fight off those growth stocks, off the SPX. And that's when people say, oh, look, the silver miners aren't following the silver chart. No, they don't follow the silver chart per se. They follow the fight between those major asset classes. So if gold is able to break out versus SPX, then I could overlay uranium charts, any type of charts that are in that complex, and they will track that pretty much. Of course, the amplitudes are different and all that, but if you take a bird's eye view, you see that tracks that. So those capital flows, they really carve out, they decide where those major allocations happen. And these they don't switch off in those capital flows. If you go, like I said, on the monthly chart, the last time we had a signal like we had in April of 2022 was in February, or in 201 or 201 or 202 in the early 1970s, late 1960s. And we had that in the late 1929, 1930. That's so 1, 2, 3. We've just had the signal 3 previous times in 100 years. And every time we've had these signals, the unwind of that, people, like the explanation you gave there, that people now, they're going to, as soon as there's a rally, well, okay, it's time, I have to sell now because I have to realize those gains for whatever reason. Or the bag holders, the people that bought at the top, now they've become resistance, right? All the people who bought at 20% from the top, now if they're down 5, 10%, 40%, as soon as the price goes up, well, they don't want to tell their wives that they lost money, right? They're going to sell. Whew, it's human nature, right? Oh, I broke even. I'm so happy. So that's going to take a lot of time to evaporate all those bag holders, right? So the price is really, every time there's a rally, everybody that bought, they're going to want to break even until people forget about that asset class, or whatever had to be purged on the macro side. The inflation, let's say it subdues, or the destruction of purchasing power does its cycle, it does its 10-year cycle, or whatever, no matter how much time it needs to just unwind. Then after that, eventually we will have a breakout of growth stocks once again versus commodities. When people say it's the death of U.S. equities, right? In 1980s on Newsweek, what was it on Barron? Death of U.S. equities. In 1980, that was the bottom for U.S. equities. Just like it was the bottom for gold in 2000 or 1999 when they said gold's a paperweight, right? But we're not there yet.
And I will say, Tuzi, right, because that magazine indicator cover, I mean, you've seen that. I mean, I've seen things like that around. It's the death of bonds too, which maybe we can say for another part of the conversation. But I want to get some of the audience. I want to get some of the audience up here. Let's go to.
Well, yeah, the chart that's posted in the space there, guys. I think Michael put it in there. Definitely, we're going to have some rally. I don't know at what moment it could happen. closely. We could have some crazy rally for the SPX. But what we got to measure right now, because any rally right now for the SPX will be happening in an environment where the SPX has broken down versus the producer price index, those, you need to consider those as bear market rallies. And what's going to be really critical right now, what I'm looking at is, as soon as a US equities rally, you want to make sure that they are outperforming the metals, because what's going to probably happen right now is silver is like a recovery metal. Silver, even gold or oil, or a whole bunch of these commodities, as a US equities reflate, they're going to reflate, but not as fast as, let's say, silver. So if you do a silver to US equities chart, ratio chart, as the US equities are reflating right now, so let's say you think where the Fibonacci levels are reached and we're going to get a strong bounce in US equities. If they're underperforming silver, that is a bad sign for US equities. That means let's say the macro landscape or environment, everything that's framing the price action is telling you, yes, there's a reflation. US equities are pricing in, I don't know, let's say an eventual Fed pivot, but the market's still pricing in more destruction of purchasing power, or monetary imbalances, and that's why they're pricing in silver at a premium. So on the rally up, silver will outperform the US equities, and that's a bad sign. That means the likelihood of US equities going back nominally or inflation adjusted, the chances that they do new highs are lower. The chances that they just continue on into a bull market where they keep doubling every X number of years, that possibly is lower. It's more like a rally you could have in, let's say, in the mid 1930s. There was a crazy rally, right? The stock market fell to like the 1931, 32 bottom, and then it did an insane rally. Like within, it could almost grab those previous highs. Or even in the 60s, it happened a few times. Late 60s, the markets crashed. And then the US equities, I think even they did a marginal new high, but they did a marginal new high in let's say the late 60s or early 70s, while being below that sleep mode line that I explained, right? That very valid rising trend line that was broken in April of 2022 on a monthly close basis. So if anybody wants to play US equities right now on a rally, it's just, for me, I just see it as being, I don't want to put the word stubborn, but you're not putting the odds in your favor. Because now, yes, you say, oh, I'm doing good, but you're having headwinds, and those headwinds, they could, at any moment, you could have a rug pull. Like, who knows how high that rally is going to go. You could get it pulled at any moment because it's not happening where it should. If that rally, if you have a strong rally when SPX was above its sleep mode line versus producer price index, so let's say in 2011, 2015, 2018 was a great example, because in 2000 or 2020, when the US equities were plummeting versus inflation, it was still above a rising trend line. It was still above the 3-year moving average or 7-year moving average versus the producer price index. It still had the tailwinds of easy money or whatever's fueling those growth stocks. So yes, it might be a rally, but if you look at that chart, the one that Michael put, we are nowhere close to the true capitulation of US equities versus the producer price index in the cycle, in the 8-year cycle, 4-year cycle, or it's probably going to be 8 years, but 8 to 12, 15 years. Like each of those previous cycles have projections. Like, so we could have a bottom in US equities in 2031, 2035, or 2041. If we have a repeat of what happened in the 30s, 40s, US equities could bottom, like a real capitulation bottom versus inflation in 2041 at like, so we don't know. We just don't know. I call this a bad zone. It's just a bad time to play anything that's growth. Even if there's a rally, even if Bitcoin rallies to 35,000, all that stuff, it's an illusion, because you got to see the performance of all those moves up. You have to measure them then versus real stuff, right? Versus divide by oil, divide by uranium, divide by silver, all the real stuff. And if that's another reason, even if there's a rally in tech stocks and Bitcoin and all that, and they're not outperforming commodities, why are you playing them, right? It's like there's no reason to even try to guess a bottom. I'm looking at this from a trader's way. I know people are locked up in their 401k plans. I don't know, there's rules, there's pension funds. I know, like, people, sometimes I see the worry in the questions people ask me, and I say, why are they asking me that? How come they're still long Tesla and all that stuff? And sometimes I try to sit in their chair, in their shoes, and I say, okay, maybe it's because they're not liquid. It's like people want to know what's happening with the housing market. Well, even if it's crashing, you have to live somewhere, right? You can't really sell that asset. But as a chart trader, I'm there to assess the risk and reward and the probabilities of reaching implied measure moves. And it's bleak in even nominal terms, but in real terms, it's bleak for anything that's growth.
Yeah, no, and it goes back to, I keep using the analogy, and people keep coming back, not seemingly fully understanding it. That's why actually I'm a big fan of Kevin's work, who I see in the audience as a meteorologist in the field as well. Kind of, it's about weather, it's about conditions. You don't know the mile marker that something's going to happen, but you know you need to slow down. The broader environment is still pretty nasty, right? So you can have these rip your face off rallies, which is consistent with all bear markets, which I say makes fools of bulls and bears. But you've got to keep in mind, right? You've got to keep in mind that that's sort of the nature of the game. And I will say also for those in the audience, first of all, everybody, please make sure you follow Patrick and check out his work on his site as well. But if you're going to listen to anybody and follow people, follow guys like him, hopefully follow guys like me, because we have skin in the game. It's not just talk. We're trying to figure things out and trying to identify the weather just like everybody else. Let's go to
the buybacks. It's funny because I started studying that because a lot of people, they ask me questions about how do share splits and dividends, Patrick, how does that influence the charts? And then I started popping up in TradingView. You could have buybacks, you could have a whole bunch of fundamental metrics. And I can't remember though. I did find something with Apple that when they stopped doing buybacks, the price could go down or up. But when I start deep diving these small elements and I can't really find correlations in that's when I take a step back and I seek refuge in just the macro capital flows. Like, again, you got to see that as a tidal wave. So it's like a tsunami. The wave is like, let's say it's pulling back or the river's drying up. No matter how bullish something, you say, oh, well, they're doing buybacks, the price has to go up. Or the argument we always keep hearing for Bitcoin, oh, there's only 21 million, Patrick. Supply's fixed, the price has to go up. Well, you're forgetting the other part of the equation, demand. So if we're in those cycles where money's drying up or there's more inflation and the growth stocks are breaking down and there's pendulum switches from these huge funds who have to reallocate, buy gold and sell their growth stocks, then no matter what bullish move a company could do, shrink their staff and do all these things, it might just not be enough until the landscape will have tailwinds for those type of behaviors. It's like, that's why another argument, like the way that the media is able to flip-flop headline news, right, or narratives. Let's say in the bull market, Apple shrugs off bad sales because of projection of future better sales. In a bull market, that's how they would spin it and the price goes up. We could take that same news in a bear market. Oh, market frowns upon these bad news, the price tumbles. And it would be for the same news event, depending where you put it in the macro landscape. Are you putting it when the SPX is breaking out versus produced price index? Or are you putting that same news event or action a company could do when SPX is breaking down versus PPI? And the price will react two different ways. And we see this all over the place. That's why it's confusing when you follow people and they just flip flop and then you don't understand, well, that guy said that's supposed to be bullish. How come the price not going up? And that's supposed to be bearish. Again, guys, just remember there's bad companies, really bad. There's frauds. I think it's Doug Casey says one of his best gains in the 2000s was a mining company that was totally fraudulent and he made huge gains on it. So at the end of the day, do you want to make money or do you want to be right on a fundamental story that is emotionally attached to you? So sorry for the tangent, but for Apple doing the buybacks, look, if the price of Apple is breaking down, then I could say they're not buying back enough. It's like there's more outflows than inflows in their stock and the price is going down, right? So that for me, it's one small element. And I would just look at the price action of the actual chart of Apple to save myself hundreds of hours of trying to digest what could move that price up or down. And for the second question, the Russell, look, yeah, this is another thing. So the SPX, we got to remember, is the top 500 companies. It's skewed upwards. They could dump the bad performing companies, right? The top 500, I think, capitalized companies in the stock market are there. And it's divided by sectors. So this really helps, like the Dow Jones probably looking better than the SPX or the Russell. the SPX or the NASDAQ, that's probably why the NASDAQ looks the worst, because the NASDAQ has most of these speculative or these growth tech stocks, right? It doesn't have the advantage of having sectors. So let's say the SPX, there's some sectors that are basic materials, there's some sectors that are energy. While some of its components are going down, they're in stage 4 declines. Let's say the tech sectors, the web, the technology, telecommunications, let's say they're going down. Well, there's other sectors picking up the slack, right? Helping soften the drops. Because if SPX was heavily weighted tech stocks, it would look like the NASDAQ, right? It'd look like a Tesla, it'd be dropping. But why aren't they going 100% as much down? Is because while some of the sectors are going down, there's other ones picking up the slack. And over time, these sectors that are picking up the slack, they might have started the bull era or the breakdown of SPX versus PPI. Let's say energy was 5% or 8% component of the SPX. By the end of the bull era, it might be 13, 15, 16%, just like the tech stocks, I think, whether 35% of the SPX or it's like they're a huge number. It's like heavily weighted. So that rebalancing within the sectors has to happen. So yeah, the Russell, I'm not 100%. I look at it. I know it's a small U.S. cap stocks, but the weighting of the sectors within the Russell will also dictate how hard it's going to fall, or like where's the floor as the rebalances. Because let's say in the Russell, they have a lot of small cap oil companies, small cap mining companies, and these are starting to get the capital flows. Well, the US, the Russell nominally might not fall as much, right? So that's the way I see it and if you're not sure, just take the Russell and divide it by the producer price index, and you'll see its overall performance. But there will be sectors I just popped it up. It's awful. It's awful measured in inflation. Massive breakdown for the Russell in versus producer price index, just like its peers are. But there will be sectors within that. So that'd probably be the best thing people right now. Look at the sectors, the 10 sectors in the SPX or the 10 sectors in the Russell or the 12 of them. Look at them individually. You could do ratios in between each sector. Take XLE, which is the energy sector, divided by, I don't know, the ticker representing another one. And whichever is breaking out versus the other, that's the one you want to be in. And you could do it's like a Mortal Kombat or Street Fighter 2 tournament. Fight them off one against the other. Compare basic materials versus energy. Oh, energy is breaking out versus basic material. Dump basic material. Then compare all those sectors, and you'll see the best sector. And that's where the odds are that you'll make more money, that your targets will have a higher probability of reaching their implied measured moves.
By the way, it's small caps relative to large. If you look at the Russell 2000 divided by the S&P, you're pretty much back to the inception of the Russell 2000. It's like goes back to like 87. The ratio has gone effectively a round trip, peaked in, I think it was late 2014. Speaking of Mortal Kombat, the challenge with small caps, I think, is the fatality. Okay, which is in other words, which is the kind of zombie companies, right? Which are going to have a hard time. I suspect, and I'm curious to hear your thoughts on this, Patrick, too, that from a cycle perspective, we're probably going to be entering a broader default cycle, right? Because with higher rates, a lot of these companies, which you can argue should no longer exist because of that high debt load, now their viability is in question.
They're going to start disappearing. So this is the cleansing process, guys. Just like we couldn't see the FTX scam in a bull market as the capital flows were kept feeding, whatever you want to call it, Ponzi or whatever. But as soon as capital flows leave, oh, hold on. There's missing money there. There's missing money there. I can't pay everybody. It's like a bank run on these stocks. And you're right. Those companies where they had easy access to easy money, and now they can't just refinance. They're going to start popping left and right and creating headwinds instead of tailwinds. And yeah, I just popped up Russell versus SPX, and the Russell is actually massively breaking down versus SPX. So imagine that SPX is breaking down versus inflation. It's about to break down versus gold. NASDAQ is broken down versus gold versus silver. And now the Russell is breaking down versus SPX. So that's the worst of the worst.
Well, and by the way, I'll argue that makes sense, though, because I keep going back. So I've done these studies before. So usually, on average, when lumber is very weak because it's a tell on housing, small caps significantly underperform large caps because they're more tied to the domestic consumer, and the domestic consumer's primary wealth is their home, right? So to the extent that lumber is telling you housing is screwed, then it would make sense that consumers are screwed.
Yes.
You look at discretionary stocks; those look screwed, right? So small caps, I think we all, yeah, and that's kind of an interesting point too. I think, Patrick, which is that when you start looking at all kinds of charts relative to each other, they do tend to tell you somewhat of the same underlying story.
Yes. And that's when you know you found a Rosetta Stone. That's when you know, how come all these charts, these ratio charts of major asset classes, they're all, you overlay them, they're pretty much the same. Yes, there's leads and lags. Sorry to reuse your name, but like one front runs the other. But overall, if you take a step back, you see a clear picture of the entire financial market. Everything's financial, guys. Look, I did a chart. It was insane. It was, I think, TLPTZ divided by TLT. I think it's the inflation protected bonds divided by the TLT, the actual bonds. If you overlay that ratio chart, you have copper, the copper chart. It's insane. It's the same chart. I have it in my Twitter somewhere. Then when you see that, you say, okay, hold on there. Why is the copper chart exactly correlated or tracing this ratio of inflation protected bonds divided by the bonds? It's like everything's financial, guys. Just like the gold silver ratio looks pretty much like the VIX. If you put the VIX and you overlay the gold silver ratio, you got a match. Or the US dollar, which likes to spike when there's volatility, you overlay that, or you take the volume of the SPX and you overlay that to gold silver ratio. All that stuff, they match overall. You could only see that if you zoom out and you have a bird's eye view, take as much data as you can, and start looking at these ratio charts. And then after that, when you compare these ratio charts, one versus the other, like the Mortal Kombat thing, you could start categorizing them. Because I think there's probably 3 or 4 different type of charts out there, maybe a little bit more, but there's not that many chart patterns out there over 40, 50 years. You're either a growth stock and you track the gold to SPX chart, or either on the inverse, you're a commodity and you track the gold to SPX chart on the inverse, and your chart pattern is going to resemble the performance of those two asset classes fighting for the M2. There's not that many chart patterns, guys. It's like you go at Baskin Robbins, you could have a million variety of ice cream. You're still going to eat ice cream. It's the same damn thing. You either choose ice cream or yogurt. That's it. You think you have choice when you buy, you're there and, I'm going to buy Tesla. It's better management than, I believe in Elon more than Jeff Bezos. All that's noise, guys. It's 100% noise. It's people want to sell whatever they sell. It's CNBC. They create branding, all that stuff. It's flash in your eye. But all these chart patterns, they are all the same. It's funny because sometimes there's this guy posting all these companies, all these different companies. They all went down 80% or 50%. And then you put on the charts, all the charts look alike. Well, what's the common denominator, guys? If all the charts look alike, does the management really make a difference? Does the product that they sell really make a difference? The fact that one's doing more buybacks than the other, does it really matter? All the charts look alike. So you have to take a step back and say, what the hell is moving these charts? And it's the capital flows, those huge charts from these huge asset classes fighting it out. So if you have a chart pattern for any single instrument, which when you overlay it looks like a ratio chart of these major asset classes, you have your answer to what is driving what. And until that ratio chart actually breaks out or down, or breaks out, and then after 5-6 years, it gives you the opposite signal, that should flash some big lights in front of your eyes and say, okay, I don't have tailwinds anymore. I don't have headwinds. Whatever was working for me on my day trading, I have to stop and accept that the rallies will get subdued or the drawdowns will be exaggerated.
Yeah, no, 100% on that. Let's go to...
Yeah, it's tough. And I know I'm trying to make more like, I started using memes. It feels cheesy, but I'm trying to decomplify, demystify, the charts, all that. Look, it depends. If you like to read, seriously, the book, I would just recommend the book that made me click. It's Stan Weinstein's Secrets for Profiting in Bull and Bear Markets. Just buy that one on Amazon. It's probably $15, or there's probably an e-version. And he has a great way of saying whatever you know about fundamentals, just take it, put it aside. And he has a very dumbed down way of just helping you spot the beginning of a trend, the end of a trend, and writing that. So that would probably be my go-to. And he talks about trend lines. It's nothing complicated system. It's like just Were you above a 30-week moving average or below with a few key observations that he's noticed over the years to reduce whipsaws and singles, right? Because just like Michael said, you want to get a single early enough to be able to ride a good risk reward, but you don't want too many singles because you don't want to get whipsawed either, right? So that's a sweet spot. So I would definitely read that, and that helps a lot there. So yeah, I do that. If you're more interactive stuff, then of course North Star Charts, or Kevin Wadworth and I, we have a website, but it's behind a paywall. But we teach at the same time that we talk. Like our members, whoever has questions, well, we're there. We elaborate stuff with them. We have like masterclass courses and stuff like that. But yeah, reading a book is a great way to like that Weinstein book. I read it like 5-6 times. I have post-it notes all over that book, and sometimes I read it 3-4 years later and say, that's what he meant by that, because that's another thing. Like anything in life, somebody could drop a whole bunch of knowledge or theory on you, but then you have to go out and practice. You have to go out and look at charts, and look some more. Then you start seeing the patterns. Because I understand, like I draw a trend line. I see the trend line before I even draw it, but I remember the first time, what is he putting the trend line on the tips, on the wicks? What? Oh, that's a trend line? What is that? Like, it's hard at the beginning. I 100% agree. It's super tough. I guess some people have more affinity to it, but anybody could do it. All you have to do is just keep staring at it, right? It's like whatever you're doing in your life, you've probably done it for thousands of hours, and that's why you're able to do it. Well, charts the same thing. There's no shortcuts. You just got to keep practicing, and eventually it just clicks, right? But I'd rather spend my time learning charts than spending countless hours doing fundamentals, where at the end of the day, you still need charts because the price is what you trade. So if you had 10,000 hours to spend, definitely go straight to the source. Just learn price.
I would echo that. I mean, there's diminishing returns to some extent when it comes to learning about markets and investing, because there's always a degree of luck and randomness. But you got to at least have the basics, right? And unfortunately, I still think a lot of the uneducated speculation that I was ranting on all throughout last year, or actually now I should say, 2 years ago in 2020, 2021, that's still in there. That's still in price movement. So yeah, there's no way out of anything. You want to be good at anything. Doesn't matter if it's markets, music, app development. You got to spend the hours. I say that kind of tongue in cheek. Let's go to.
Yeah, I just it's weird because I didn't look too often at that chart. It's kind of a peculiar because it's been going sideways. It's never reached its 2007 top. But it rallied insane from 2002 to 2007. If I overlay the oil chart on that, it looks like it overlaid. And that's the advantage of looking at a lot of charts. You right away, like your brain, it's essentially you're looking at the oil chart pretty much. Oil's going to go up. That thing has a chance of going up also. Super interesting. I might do a post on that on Twitter. Yeah, it looks just like the oil chart. If it's tracking the oil chart, means it's reacting to it's anti-growth stock, so it's tracking. It probably has some growth stocks in it, but maybe the way it's balanced, that ETF, it has sectors where it'll favor instrument flows that are not growth sensitive. So it could be a whole mixture of those sectors, etc., creating the ultimate pattern that we see. But there's definitely some clues in there. That's another one there. Just before maybe the next question. I did a music video on Twitter, guys. It's oil versus SPX is exactly when there's a bull era, when oil breaks out versus SPX, it's exactly the silver chart. So that's another way of when oil breaks out versus SPX and goes ballistic, it's silver tracks those same capital flows. So silver does track gold versus SPX, but it tracks, I think, even better oil's outperformance of SPX. And you gotta always now. You gotta look at all these ratio charts, memorize them practically, the big ones, and then when you start looking at charts, individual charts, you'll know exactly what you're dealing with, and it'll synthesize so much faster the information instead of just being a random chart. And why is it like that? Then you say, oh look, that chart tracking that ratio chart of those major asset classes, and right away you'll know pretty much what you're dealing with. Yes, it's crazy. I don't like. It's so weird there. Sometimes I try to think why, but it's like it's a word financialized. Like you said, standardized, but I don't know how it happens. And some people say, well, is it because it's AI or there wasn't AI back in the 70s, but these racial charts were still being bought by humans and sold by humans, and the instruments of, let's say, silver was tracking to perfection the oil to SPX chart back in the 70s. But yeah, definitely the markets are efficient in a way that they are pricing in stuff to track those capital flows moving from one asset class to the other, no matter what the fundamental reasons why. Right? It's like this was. I love the silver guys, but the silver squeeze talk and this comics going bankrupt. Fine, guys, that's great discussion, but like it doesn't change anything into what silver price is actually going to do, guys. If it's just superfluous information. So I haven't answered yet the question why, the exact why, but maybe Michael has some ideas why silver tracks oil to SPX or why they have to do that. But at the end of the day,
I have a very like simplistic, answer, and it's a little self-serving, but I forget who it was. Many years ago, it stood out to me as sort of a way of thinking about markets. Somebody said there's really only two asset classes, right? Those that benefit from low volatility and those that benefit from high volatility. Everything else is moving off of idiosyncratic things, but the reality is everything kind of co-moves to some extent in similar ways because everything's moving off the same factors, and volatility is around liquidity. So, to the extent that there's this sort of consistent story and movement that happens from an intermarket perspective, yes, there's a degree of financialization. Yes, there's a degree of forced co-movements because of the wrappers that keep static allocations, right, in the way these things are constructed. But I think that the simplest answer is usually the right one, that, it's just like beta is what drives, equities. There's a lot of underlying sort of similarities in terms of what drives different asset classes and sectors to each other, which is why it becomes very hard to beat any single one thing because everything's moving off of the same underlying reasons.
Yeah, that makes total sense. So so you use those ratio charts to your advantage. So even if so once again, I might be repeating myself, but once those major asset classes, one's outperforming the other, well, yes, all the charts I could overlay, let's say in the tech boom, I could have overlaid the Bitcoin, Shopify, whatever, name them. All the charts look alike, but you could still do ratio charts in between those specific assets and choose the best performing ones to maximize your returns, right? So not because everything's moving in the same direction that you have to choose the one that's moving the same direction, but not creating as much gains, right? All the chart patterns look alike, but you could do ratio charts off each one of them and then choose the one that's going to give you the best return. And that's when you're in an A++ stock.
Yeah, no, I'm in agreement with that. We'll do one more last question to...
Look, causation, who cares? This is the trap question, causation, because look, I'll tell you something. I did some trades in the same 2008. I read the Stan Weinstein book like a year before, and I saw the SPX was breaking down on its below 30-week moving average. It was in a stage 4 decline, and I just went nuts and shorted like crazy. But I wasn't aware back then of the SPX versus PPI. I didn't know that I was in a macro environment where SPX had broken down versus PPI, and that the 2008 crash had a higher chance of happening and being prolonged than not. And I thought the stocks were going down because for whatever reason, right? It was a crash of Lehman Brothers, or there were bad management, and then years later, I realized that it wasn't because of all that. It was because capital flows or whatever were evaporating from those sectors, and there was a cleansing. So it's crazy because now I know that what I thought I knew moved the price, or just like, let's say a stock goes up. Let's say you have a fundamental reason. You say, oh, the stock's going up, good management. They found a drill hole. They found ounces. But then years later, you realize, it wasn't even that. It was something else. Let's say you hear a story, you talk to the president tells you, oh, no, it wasn't even moving because of that. It's because we had this other project you didn't even know about. So the cause, it doesn't really matter because it's the result. It's the aggregate of all these causes, these possible causes of all that stuff, and people placing their bets on what they think is the cause or what's going to be discounted in the future. It's the actual result, the price chart that matters. All the rest, it's it's coffee table discussions. You could have fun with it. But trust me, years later, you'll say, oh, Jesus, that was totally not why it moved. Even today, I'm pretty sure in 4 years, I'm going to look and say, oh, Patrick, there was something else we were missing there. There was there's a chart, there's a ratio, there's something I was missing. And that's why it's all about probabilities. and the cause, it's secondary. It's really like have fun with it, but it's not necessary at all to make money in the stock market, knowing the cause.
Yeah, and I will say that's where a lot of people get sucked into a lot of the stuff that you see on FinTwit, especially, by the way, if you're rules-based, right? I mean, the cause of any signal not working or the opportunity set not working for a moment in time, okay, interesting to talk about, but if you're going to follow a trading strategy that's regimented and you have a process, the last thing you want to do is try to editorialize based on a narrative that may have nothing to do with the why.
Yeah. It's fun. Some people like it emotionally, like psychologically going through that process, but it's useless. At the end of the day, it's useless if you want to make money. It just is. It's more the number of times it repeats the pattern that creates my confidence level that will continue repeating. So in chart trading, like I said, a trend line needs at least 3 bounces. And then on the 4th, it's valid, it breaks down. Then I know based on all the chart patterns that ever existed that these rising trend lines at that angle, when they have a break below the 3-year moving average, most of the time, an 80% chance that the implied measured move was reached. That's why chart trading works. So let's say I have this pattern over 100 years. I've had 3 previous, now it's the 4th one. And each time that exact signal happened, no matter what the cause was of that, let's say SPX breaking down versus PPI, it produced X results, and then I could overlay the gold silver chart. I see the performance of all those asset classes, that they all perform the same way each time I had those racial charts break down in the same way. Then the probabilities for me, they go up. So that's what I want to play. I want to play 80% chance in my favor and a 20% chance not in my favor. I'm good to go. I'm not looking for 100%. So the cause, it's not actually the actual cause, but it's more, or the correlation of it's more how many times did it repeat. The more times it repeated and the more times the instruments I want to trade behaved in the same manner when that environment occurred, my head is just ringing bell lights saying this is a high probability play and I should take a stab at it.
Yeah, I think that's a good way to frame it. Everybody, again, please make sure you follow Patrick. Appreciate you spending the hour here with us. Again, this will be a podcast under Lead Lag Live on all your favorite platforms. Everybody, again, happy few year to everybody here. Thank you, Patrick. Appreciate it.